half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne with Annabelle Jewelers.
Our top stories: Asian stocks and US futures under pressure after President Trump's threat of a 30% tariff rate for the European Union and Mexico. Bond traders casting doubt on a September Fed cut ahead of key US inflation figures.
US Secretary of State Marco Rubio says a Trump-Xi summit is now likely after what he calls a constructive meeting with China's Wang in Malaysia.
And June trade numbers out soon may show an uptick in Chinese exports thanks to the tariff truce with Washington. Well, happy Monday. There is certainly a lot for investors to be tracking this morning as we get online. I mean, first and foremost, you had President Trump over the weekend outlining further tariffs of that 30% risk now for Mexico and also the EU. The question, of course, is does he really follow through on this? And we've got investors that are saying don't expect him to back out necessarily, because that really has been sort of the trading sentiment, that investors have sort of seen those initial headlines crossing a bit of initial reaction, but ultimately looking past it. But today in the session, you've got the broader gauge that's flat, and you're also seeing trading volumes looking fairly thin right now. What has also been interesting, those dynamics we're seeing around gold here, you can see rising up 0.6%. It's not just around trade. You've also got US inflation figures out later this week, going to be really key for the direction that the Fed takes from here, and also just that continued pressure that we see on Jay Powell from Trump to cut rates. So you're seeing gold here really bid. But let's take a look also what we're expecting ahead of the Chinese session this morning, because it's a very, very heavy data dump to start the week. So tomorrow we've got GDP activity numbers that are due. We're in the window now for the credit data as well. But also later today, we're going to have those trade figures coming out. And as I said, we could actually see a bit of an uptick in exports, given you had that 90-day trade truce that was signed back in Geneva. But here you're seeing equities a little bit under pressure. What's also something to track is just what sort of policy response we get around this so-called anti-involution trend. If you take a look at Google searches, for instance, you can see that they've really been picking up here in that expectation. If you take a look at this terminal chart, how Beijing is going to tackle excessive competition amongst not only the public but also the private sector. It's one of the reasons you've seen onshore stocks outperforming their Hong Kong peers of late. This expectation, as I said, you will see some sort of policy response. Investors have been a little bit reluctant to invest in mainland stocks, just given those excessive competition pressures.
Yeah, we certainly have seen that in multiple sectors, like EVs, when it comes to food delivery, for example. This whole kind of anti-involution, this Beijing, it's becoming really quite a buzzword across markets as well. In terms of your agenda here today, it's Albanese, the Prime Minister of Australia, that's in China. Expected to see how he's going to shore up the ties there with Beijing. There's also a meeting of SEOs there to take a look at their foreign ministers meeting that China is going to be hosting as well. There's a PBOC briefing talking about the first half financial data later on this afternoon. Bell mentioned the June trade data as well. And of course, we're still in that window for credit data out of China as well, just ahead, of course, of that data dump tomorrow, right? Let's get to our top story now.
Yeah, President Trump, we had him addressing reporters early this morning, but essentially saying that the European Union, rather, is talking to the US on trade. That comes after he unleashed his latest tariff ultimatums, threatening a 30% tariff rate for the bloc and also Mexico from August 1st if they can't negotiate better terms.
So the European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country. South Korea wants to make a deal other than tariffs. Right now, as you know, they're paying a substantial tariff, but they want to make a difference. So some of these deals, maybe I'll change them and maybe I won't.
Let's bring in our Chief North Asia correspondent, Stephen Engel. And you just heard there from President Trump saying that the US and the EU are talking, but we also know the EU is talking with other nations, and they're looking at ways that they can counter this risk as well.
I think the key was at the end of that soundbite when he says, maybe I'll change them, maybe I won't, right? And that's what the market is kind of latched onto as well. I wouldn't say flip-flopping, but it's back and forth, obviously, on whether deals are going to be made soon or are we close to the finish line and then something else pops up. And that is definitely the case with the EU, where they were not initially given this letter as other nations were, and they were initially given a 20% tariff. And then the progress in negotiations didn't really go that far, and that frustrated Trump. He threatened 50%. Now they've come back to a 30%. We don't know where we're going to end up, right, if there's negotiations that are going on in good faith. There's a lot of issues with agricultural products. There's issues with automobiles. Still a long way to go. But you're absolutely right, Belle. The European Union is starting to engage in, with more earnest, with like Japan, with Canada and others as a mitigating factor. They're also suspending until that August 1st deadline the contingency, the countermeasures that they have been put in place that were supposed to snap back into place tomorrow on Tuesday. They're also lining up another package potentially to put forward to EU members that is double or triple the size as well of countermeasures. So Europe is playing both sides. They're trying to get a deal done with the United States while at the same time kind of protecting themselves going forward. There's only 19 days until August 1st. That's 3 full business weeks, not including the weekends. That will go by so quickly to August 1st. Mexico, I want to get to them really quickly because they're the other ones that got that 30% tariff. There's confidence coming from Mexico City that a deal can be done. Donald Trump, in his letter to President Sheinbaum, did indicate that there's been progress on the fentanyl and the border issues, but not enough. So we'll have to see if there can be a deal in the next 19 days.
Okay, that's the latest. He mentioned South Korea, that they're close to some sort of deal. We also have India to deal with as well. Right. What progress has been made on those two fronts?
There's confidence that a deal, an interim deal with India can be struck, but we heard this as well, that they were close to a deal. Donald Trump had said that they were close to a deal. Then there was the BRICS summit in Brazil. They came out with some policies that Trump did not like, whether it was with the attacks in Tehran or the unilateral, quote-unquote, nature of his tariff regime and trade negotiations. So he's added that 10% threat onto any members of the BRIC nations that align with those policies that came out of that weekend summit the weekend before last. So, again, there's a lot of uncertainty with India. There's genetically modified crops, American crops, that the Indians do not want to take in. There's issues with automobiles. There's issues with steel. All kinds of issues. So again, I'm going to put that in let's wait and see category. South Korea, the trade negotiator Yo just came back from Washington. He's back in Seoul. There's confidence that, again, a deal can be reached. Donald Trump said in the soundbite the South Koreans definitely want to get a deal done. But again, there's been fits and starts here. This is what the trade minister Yo had to say. We are focused on swiftly reaching a landing zone. His words. There now is trust built to accelerate negotiations. We have entered a critical phase. We'll have to see again. That also is in the wait-and-see category.
All right, Steve. Thank you, Steve Ingles, there, our chief Malaysia correspondent, with the latest. Meanwhile, of course, as you wrap up that ASEAN summit in KL, the U.S. Secretary of State Marco Rubio says a summit between Presidents Trump and Xi is likely after the top diplomats from the two countries met in Malaysia.
The odds are high. I think both sides want to see it happen. Obviously, we have to build the right atmosphere and the right deliverables so that a visit isn't just a visit, but it actually has some takeaways from it that are concrete. But there's a strong desire on both sides to do it. The president wants to do it. The Chinese side wants to see it happen. President Xi said that publicly. So I think the odds are high. I don't have a date for you, but I think it's coming. It'll happen.
For more, let's bring in our China correspondent, Min Lo. So it looks like there might be a summit, or maybe not. What else came out of this discussion?
Well, actually, we didn't get a lot of substance from that discussion so far, at least from the official readouts. The Chinese readout basically said that the meeting was constructive and pragmatic, that both sides agreed to strengthen communication at all levels to manage their differences and to deepen cooperation. And there you heard Marco Rubio saying that we could see a Xi-Trump summit sometime, but he refused to put a date on it. He says that there should be, they should be building towards the right atmosphere. And it does look like the atmosphere is becoming a little bit more right, because because at least the two men sat down and speak to each other face to face for the first time. This is the highest level meeting between China and the US since Trump came into power. And of course, there are a lot of, other sticking points, including trade issues. But Marco Rubio isn't really someone who has a lot of power when it comes to deciding on trade issues. Howard Lutnick, Scott Bessent have said they will be meeting with their Chinese counterparts in the coming weeks. But yes, so it looks like at least there is some stabilization of ties as both sides, have been showing some signals of dialing back some of the export controls, especially when it comes to things like the flow of rare earths, jet engines, and the like.
Yeah, and that sort of rapprochement that we saw starting in Geneva early this year actually could end up showing up in the trade figures that are due later today.
Yeah, so the forecast for June's trade figures is 5%, which is slightly better than the previous month's 4.8%. Bloomberg Economics is a little bit more optimistic, looking at over 6% growth in exports this year. And as you said, already we are seeing the high-frequency data of trade showing a rebound in exports starting from late May onwards because of that trade truce. And you look at the chart there, imports expected to be 0.3%. That's the first positive print since February of this year. And a part of it is not just the trade truce, it's also this global recovery in the economy as well. If you look at the PMI data for US and Eurozone, we are seeing contraction at a milder pace. You look at Japan's PMI that was in expansion for the first time in about a year. South Korea's exports was pretty strong as well in June, and that's always a bellwether for Asian trade as well. We're expecting to get the GDP data tomorrow, and that's expected to come in at 5.1% in the second quarter. Slower than the first quarter, but overall it brings the first half growth to about 5.3, which is comfortably above that growth target of 5%, which means that, authorities may not feel that it's so urgent to roll out more stimulus in the near future.
Yes, certainly maybe eases that pressure for further stimulus. But that's our China correspondent, Min Lo, there. And we're actually going to dig into the details next. Again, more on the trade dump that's due, or the trade figures that are due, plus GDP, credit, activity numbers. Societe Generale is joining us with their outlook on the Chinese economy. We'll have more on that just ahead. You're watching The China Show, and this is Bloomberg. You're watching The China Show and taking a look at what to watch this week. And really, I think there's sort of two key events that investors can look out for. Firstly, you have the inflation readings that are due in the US midweek, and that's going to be really key for understanding what does this mean for the direction of the Fed? What does it mean for the direction for risk sentiment in the second half of this year? So, I mean, we had expectations around a September Fed rate cut, but is that even going to be priced out? And will investors be pushing back their expectations or their hopes for the easing cycle? But as I said, due Tuesday reaction for us in Asia on Wednesday. But of course, it's that big focus as well on the Chinese eco figures. Not only do you have trade that's due out shortly, but you've also got GDP, activity. We're in the window for credit as well.
Yeah, it's going to tell us how things are doing in this 90-day trade truce period, obviously, but then there's a lot of questions on just how sustainable this data is going to be, right? It's been holding up of late, but what does it mean for the back half of this year? Joining us now is Wei Yao, head of research and chief APEC economist at Societe Generale. You've been talking about, right, the impact from front-loading, consumer subsidies. That's holding up the data so far. How are you assessing things are going to look like in the second half?
Well, the second half will be a much bigger challenge, obviously. Right? It's actually not just for China, but for Asia, that we all know, tariff or not, the exports to the U.S. going to fall off a cliff at some point. Right? So then talking about the domestic policy, yes, there are consumer subsidies, but we all know this is actually a small piece, and, it's not really big enough in terms of, offset this extra deflationary shock to the economy from the trade war. And we're already seeing the housing sentiment weaken again. So all these are very ominous signs that the government has to step up at some point. The challenge is always when exactly, right? Sometimes it seems they're patient. Sometimes it's like the data is getting worse, the deflation data, the housing data. So, yeah, I think it's inevitable that they will do something. The timing is tricky.
Yeah, what would they do, though? Because I think, as well, to your point, that there's obviously a transmission effect here, and it's difficult to know when exactly to step in. But you take a look at, for instance, GDP figures, which are backward-looking, but they could come in stronger than expected.
Well, they could. I think the government, the Chinese government also must understand this point about the front-loading, right? I mean, this is obvious to the whole world. And I think they can also see that the housing is really not doing well. At the beginning of the year, the first-tier cities are bouncing back, but now everything's coming off again. So I think, in terms of what they can do, right, stabilizing housing still, I think the most important thing for stabilizing the entire domestic demand and the consumption. So there, they need to step up probably on the destocking projects, one of those. So if the social rental program is too hard to do, what about the cash handouts? This is something they did in the past. It was successful, maybe too much, several years ago, but they can do it again. And, so these are the options they already, pretty much already on the table. It's a matter of, pushing through with stronger willingness and support.
Yeah, we've seen some speculation in the markets that we're expecting some sort of housing market sort of stimulus here. You're saying then it has to be beyond demand side sort of measures here.
Yes. Yeah.
Is it going to be more incremental, do you think? I mean, is it going to be more large scale? I mean, what do you think needs to be really needed now?
Well, we all wish and we all think that it should be large scale. I think there's no disagreement, among, the private sector side, because we all know that how weak the sector is, right? The only thing, though, is that the Chinese government is always coming from a place that there are a lot of structural issues in the system. And if we're talking about structural issues, then there is no quick solution. That's where they come from, right? So I think the risk is that they're still too slow and too incremental, but it only increases the chance that something bigger and something less incremental have to come at a later point, right? For me, it's like next 6 months, there is a downside risk to the deflation and China problem. But if we look at next 2 years, I think a lot of the policy we expect, even including, supply side policy, that will come.
How does that also stack up against the other policy focus for China, which is the anti-involution trend and cracking down on that excessive price competition?
Right. So this is all the part of, this bigger picture that there is definitely clear awareness as in the imbalance in the supply-demand policy is hurting them now, right? The production support or the industrial policy is successful to a point now. If we look at the long term, how can China continue to rely on exports? This is just logically wrong, right, for such a big economy. So they know they're wrong. They know this is very toxic, right? If companies cannot make money, then also how can you innovate, right? What money do you have to innovate? The only problem, though, is that the pressure is not yet high enough for them to do concrete and material things. I'm slightly more optimistic than some of the others that I do think China can do it. I do think we will see a supply-side consolidation, industrial consolidation with quite a few sectors in the coming 2 years. I do think it will happen. But the last hurdle always is the local governments, right? They want to protect their local companies. They want to protect jobs, probably even more so now given how weak everything is. So you do need the central government becoming tougher and tougher and tougher, eventually overruling the local governments here. And China gone through this in 2015-16. I do think they will do it again, yeah.
Is it a bit more challenging this time around because it seems like all the excess capacity, all the price competition that we're seeing is in the private sector?
Yes, that is more challenging, definitely. So. But some of the root cause is similar, is the extreme of the industrial policy, right? So if we were talking about private sector, yes, EV companies are private sector, solars they are. Don't forget that solar sector actually gone through a sector consolidation, a decade ago. So that's what I mean, they could do it. But these are also the result of the industrial competition, right? But if we're talking about other consumer goods, these are because of the weak demand. Right, so there are two problems here. But I think, for some of the sectors, it's still the government action that will make a difference in the background.
You mentioned that sort of reluctance on local governments as well and that concern around the jobs picture. What happens, though, if you do have that sustained crackdown on anti-involution and you see that pick up in unemployment and then that also feeds back into domestic consumption as well?
Yes. So when we think about China policy, it's actually not cutting something... just cutting, let's say, the support to the industrial side. We're talking about relocation of resources, right? So this is the whole picture. This is the two sides of the same coin. Because they did too much for the supply, they didn't offer enough for the demand. So if they can rechannel some of the resource, that would balance things out. Yes, in the short term, you could still get a bit worse. I think that's possible, but that is the necessary step.
I want to get your take overall on just why we see markets continuing to sort of ignore maybe some of the domestic side of things, but also even just the external threats of tariffs.
Right.
What do you think is supporting risk assets here right now? Is it really the possibility that the Fed, at the end of the day, they're going to cut? But even that possibility seems to be being dialed back now.
I think Fed cuts are just still a matter of time, right? I understand there's all these very complicated situation with, Powell's future. However, when we think about the tariff war, one thing I think the market probably is taking big relief is, the U.S.-China trade talk seems to be okay, right? I think the logic is a very important one for the whole market is that we know that the U.S. and China, these two countries are too big, too important for each other. They cannot live without each other. Even if they want to, let's say, go for a divorce in the long run, we need to manage it, right? There needs to be some pacing of the decoupling process. So there is this understanding now we can see. And so this kind of set the foundation that one, it will not get too bad in this relationship, which is already quite something. And second, it also shows that the U.S. administration definitely have some pain thresholds, right? But you could say, it's a kind of a catch-22 is that the market's not panicking, then it may embolden Trump administration to do something. But our view is that, we already know enough about the tariff framework. 10% is the minimum. China is the ceiling. China +1, transshipping is in the middle, right? Then what about EU? Okay, there is a question mark, but we all know that at the end of the day, EU is also a very big economic bloc, very important for the U.S. economy. It cannot get too worse. Yeah.
Wei, thanks so much for joining us. That was Wei Yao there, Head of Research and Chief Economist for APAC at Societe Generale. And just taking a look at how markets are trading this morning, we're a little bit under pressure, but as Wei was saying, there is that big question, taco, not taco, how much do we already know of the contours of different trade agreements that could take place? But certainly this threat from President Trump to put 30% duties on the EU and also Mexico is weighing on sentiment. Yuan, reference rate at the bottom of your screen. We'll have more ahead. This is Bloomberg. Just under 5 minutes away from the open of mainland and Hong Kong markets this morning. Taking a look at the pre-market session here, and you can see we're setting up a little bit under pressure so far today. Yuan reference rate has been another stronger fix, so coming in at 7.1491. The estimate had been for 7.1772. But certainly, of course, the direction of where the yuan goes is going to be very much dependent on what the dollar does, but also the trade talks.
And we've actually bounced off some of the July lows for the dollar already. So is this a sign that maybe things are being, looking better for the dollar? Are we starting to price out the possibilities Fed cuts? That certainly is a key question for the market here right now. To the stocks to watch, we're watching Bejing Mining. Those earnings that came out here look pretty good. The stock is up some 1% right now, but that first half net income was about 10% up from year to date, or year to year, I should say. Also, the likes of Bloomberg Intelligence is saying some of these Chinese smelters might actually benefit from that 50% U.S. tariff on copper imports as well. We got plenty more to come. The open is next. This is Bloomberg.
Welcome back. You're watching the China Show this morning, and we're counting down to the open of mainland Hong Kong markets. We're setting up for a day a little bit in the red, but I think it's going to be really interesting just to watch trading volumes as well, because you can expect those to be fairly thin, kind of mirroring what we're seeing in the Asian session so far with these Trump tariff headlines in focus, but also just because we're awaiting so much key data from China. You've got trade figures out later this morning, GDP, activity, window for credit. I mean, we've got a lot to watch for.
Yeah, and it's interesting when you're talking about how markets are doing in China. I mean, you're starting to see actually the A-share market come back and catch up to the A-share market in some ways. There's a lot of bets about what policy is going to be looking like. There's obviously speculation about the property sector as well. This whole supply side reform and how that could actually help equities in some ways as well. But yes, the whole brushing aside of tariffs sort of narrative, that doesn't seem to be really happening here today. You're seeing slight pressure to equities there, but onshore, we're doing okay. We're up about 1/5 at the open in Shanghai here right now. We're watching very closely what this all means when it likes to the copper, iron ore, Shanghai Shanghai crude not doing too much here when it comes to copper, but Shanghai crude is up about 2% here this morning. But yes, the whole fresh threat about 30% tariffs on the likes of Mexico and the EU, that seems to be sort of the big sort of headwind here today to contend with. You take a look at how Hong Kong's doing, and it seems like right now, Hong Kong's doing this, right? So obviously there's been a lot of talk about what sort of property stimulus we might actually see. The property sector was sort of a big standout last week. That seems to be coming off that a little bit here today. We'll see. But Hang Seng property is still doing okay. That's more of the Hong Kong side of things, though. But yes, we're watching very closely HS Tech. That's down about 0.1%. H shares are catching a slight bid here this morning. So Hong Kong doing slightly better than the rest of this region here today, although the Kospi, as we've been talking about, has been a standout. Goldman Sachs just upgraded their view on Korea as well, just given corporate governance reform and the like there. JP Morgan is also talking about that index could rise to about 5,000 in about 2 years, I believe. So certainly there's a lot of optimism around Korea here this morning as well. It's pretty slow in terms of news-wise, but you take a look at how these tech players are doing. Alibaba, Meituan, those are still kind of the big bottlenecks there. Baidu's down some close to 3%. So obviously food competition, food price wars, and all the like, food delivery, I should say, still seems to be one of the things that's an overhang on some of these stocks in particular today. Bejing Mining, that's the one to watch here. So obviously there's been a lot of talk about the earnings side of things and how things are looking pretty good there. Bejing Mining is up some 2% on that stock. So prelim first half net income came in around 23 billion renminbi. That is sort of a 10% gain from a year ago. And certainly, you take a look at how these copper tariffs are going. Bloomberg Intelligence has a pretty interesting note saying what you're seeing and what President Trump has threatened with 50% tariffs on copper, that actually may benefit some of these Chinese smelters because you could be seeing a redirection of some of these copper flows away from the U.S. to China possibly, right? So that's one thing to watch. China developers are doing this. Last Friday, we saw a bit of a drop-off there. There you go. We're up once again. And some of these names in your Bloomberg Intelligence China Developers Index is up. There's a lot of talk. Even Goldman Sachs is writing a new note about what sort of stimulus we could see in the property sector. Greenland Holdings is up some 10% right now. But Goldman is saying, look, any upcoming China property support, likely incremental and maybe not so much large scale.
Yeah, let's get more on the broader market outlook now, bringing our executive editor for Asia markets, Paul Dobson, joining us. So really great to have you in studio this morning. I think when we take a look at how markets have been trading over the past few weeks, it really is that expectation around the taco trade and that these tariffs won't actually materialize. Is that really the way that investors want to be thinking about that? And second to it, just how much are we underpricing also this risk around a potential dismissal of Jay Powell? I mean, there just seems like there's a few major risk events that maybe are being underappreciated. Yeah, the market definitely seems to have that sort of sheen of invincibility about it at the moment. And we are starting to see that fray just a little bit, I think, Annabelle. What we saw at the end of last week was just a little bit of nervous tension creeping back into things. We heard warnings from the likes of Jamie Dimon saying, market's too complacent here. These trade risks could still kind of escalate again. And then we had on top of that, as you mentioned, the pressure on Jerome Powell, which could, really provide some pretty extreme moves in markets, judging by what economists are saying. If he were deposed, that brings into question the very credibility of the US central bank. So there are risks hanging out there. I think at the end of last week, we saw a little bit of a combination. We saw stocks coming off, admittedly record highs. We saw the strongest week for the dollar since February. We saw junk bond spreads widening quite aggressively as well. And the emerging markets came under pressure across the board, particularly in Latin America. So there are little bits of signs of people getting a little bit more nervous, and we're seeing that feeding through into the early morning action today. How important is this US CPI print this week? Is it it seems like it's going to set the tone for the direction of the Fed and really how Treasuries are going to perform the rest of the year. Yeah, so it's interesting because the September seemed nailed on as the first time that the Fed's going to start cutting again for so long. And people are just starting to question that a little bit now, maybe pushing back those bets even further. So it'd be really interesting to see the CPI, how much of an immediate tariff impacts we get. And we were starting to hear stuff from the Fed speakers at the end of last week talking about, maybe it's going to be a whole year of sort of feed through of the tariff impact, drips and drabs. Maybe the US, kind of retailers are going to start sharing those costs a little bit with the exporters, and so maybe that balances out and doesn't make such a big splash in terms of US inflation numbers. So people will be watching that pretty carefully to see what sort of a takeaway they can put on it. And what are people also going to be watching from the China figures? Because we've got the trade ones out, for instance, later this morning. How much weight are people going to be putting on those, given you've got just broadly expectations for that big deterioration in the second half?
Yeah. Well, China at least is in the clear as far as the tariffs go, kind of has a little bit of a breathing space that the rest of the world doesn't have, and I think that's probably why you're seeing gauges here a little bit more balanced at the start of trading today. People are going to pick through all of that data. So far, things look good because we had the big front-loading of the exports in the first half to beat the tariff deadlines, and now we'll see whether the economy can remain resilient and whether they can do something to tackle this kind of disinflationary mindset that still seems to be dogging everything at the moment.
Paul, it's great to have you here in Hong Kong. Paul Dobson here, our executive editor for Asia Markets. There's also a term that we've been kind of talking about in our newsroom here this morning, Belle.
Anti-Involution.
Yeah, last week as well. And it's recently emerged as sort of a catchphrase. You take a look at how searches are about this whole term, anti-involution, and that basically has shot up on people trying to decode the policy intentions around the mainland and really navigating the stock market right now. And it has appeared in government documents over the past year and has started to gain prominence when President Xi chaired that high-level meeting this month that pledged to regulate price competition. For more on this, let's bring in our Asia equities reporter, Winnie Xu. She's with us to really define what involution really means, this whole concept of neijian.
Yeah, exactly. So like you mentioned, in Chinese, it says neijian, and nei literally means inwards, and juan means rolling. So it's describing this inward kind of fierce competition that really is not getting too much of a significant output or a significant impact. So that price competition we've been talking about, across in EVs and the food delivery sector. So that's in general what we're seeing in the Chinese market, that there's just this ongoing price competition going on. But this idea of kind of solving the involution issue of this fierce price competition has been on the government's agenda in the past year. So lots of talks being discussed, but it really is this meeting earlier in the month where we've got President Xi to come in to say that we have to curb this kind of disorderly competition going on that really gained investors' attention.
And so you're seeing markets that have been rising off the expectation that China really will be able to tackle what's a very complex problem. So what's been the response of that, and how patient, I guess, a trade is going to be as well, given it could take a while to essentially solve?
Yeah, so like you said, there is some initial excitement that we're seeing. We can see that reflected in the markets, that the CSI 300 onshore market has outperformed HSCEI in the past month, and that is, we've got lots of industrial names on the onshore market, so expectation for that to really boost the stocks, the solar stocks, the steel stocks, that has kind of pushed that sector, that has pushed that gauge to really outperform HSCEI. That was actually doing a lot better earlier in the year when we had the optimism around DeepSeek. So that reversal is really interesting that we're seeing right now. However, it seems like it's still on the more tactical side of things right now, because the longer term money and the fund managers are really still taking a step back to see if this policy, we're going to see more details, and if we're going to see more data. And the data that they wanted to see is if the prices are actually going to stabilize, whether it's the news that we've got today around how coal prices have started to rise. So as we see these data to start to trickle in, that might help investors to gain more confidence that this policy this time around is a little bit more different than what we saw back in 2015.
All right, let's leave it there with you, Winnie. That was our Asia equities reporter, Winnie Xu, rather. But let's get more on the difference maybe of what we see today versus going back to 2015. And is this going to be an easier moment for China to essentially tackle this excessive competition across a range of different industries? Let's get more with our opinion columnist, Shirley Ren, who thinks that these price wars are far more dangerous than US tariffs. So Shirley, exactly to that point that Winnie was just referencing there, back in 2015, President Xi was able to make some improvements, and PPI inflation did turn positive. Is it going to be quite as easy this time around?
It will be a lot harder. To President Xi's credit, he did a pretty good job. After the late 2015 supply-side reform, China's PPI inflation went into the positive territory within half a year, right? He cut production on the steel and coal sectors. But this time around, what we are seeing are the more consumer-facing sectors, like EV industry, right? And the problem with these sectors, from solar, EV to commerce, they're largely privately held enterprises. They're not the SOE, coal and steel producers. President Xi cannot tell them, okay, you cut production and they stop production. It's not going to work that way. The government has to try harder coercing and coaxing private enterprises to cut their capacity. Another problem is the local government incentives. I mean, if we look at the EV sector, the reason why there are so many of them flourishing, right? Even China has about 60 car producers, even though half of them are subscale. They should have exited a long time ago. A big reason is because local governments, they have been acting as venture capitalists, giving companies money, and the companies in turn promising to open factories in their local regions. The Hefei model is very famous. Hefei, the city of Hefei, they actually invested hugely into NIO at the beginning of the pandemic, and NIO is still around, and they are producing 200,000 cars a year at the 100,000 yuan each car loss, you know. And a third problem is stimulus. Even the 2015 supply-side reform, the Chinese government did a huge housing boost. They did the so-called shantytown redevelopment program. The PBOC pumped 3 trillion yuan of cheap loans into the Chinese economy, into the housing sector. And that is the main reason why China came out of recession. The deflation. So the question is whether the Chinese government has the stomach to do another stimulus. Yeah. I mean, 10 years on, the Chinese economy is so much bigger, right? 3 trillion yuan is going to be nothing.
We're seeing this across, as you say, multiple sectors, right? I think food delivery is probably one of the most painful here right now. Are there ways to tackle this on the demand side?
I think they just have to make people feel wealthier, right? The housing market has been in the dump, let's put it mildly. And a lot of middle class, they don't feel that wealthy. So the government has to putting more stimulus. They have tried a lot of things, like giving out the consumption coupons, you know, like the trading programs. These are just short-term boosts, but the people's confidence is still not there. So they have to do something like, they have to bring the big gun out.
All right. Well, thanks. We'll wait to see what those big guns are, but certainly I guess we're going to have these trade figures. We're going to get a lot of data this week that's also going to really just tell us, is there that need for further stimulus? But so far the expectation is maybe not something big bang just yet.
Well, the data hasn't turned sour yet. Right, that's the big thing as well. But as Shuli mentioned, right, we have to focus on what's happening domestically more so than external threats out there. Thanks to Shuli Ryan, our Bloomberg Opinion columnist, on this whole anti-involution sort of story that seems to be evolving every day. And there's more about price wars coming up as well. We're going to have a few minutes to talk about the equity impact. What does this mean? UBS Global Wealth Management's Yvonne is going to join us to talk about their latest outlook when it comes to Chinese equities. This is Bloomberg. Some other stories we're tracking for you this morning. Iran's foreign minister says the U.S. is trying to restart nuclear talks, but stressed his country is in no hurry to engage. Abbas Araghchi said in televised remarks that Iran had received multiple messages and is weighing options. And he added that Iran needs guarantees it won't be attacked again if the talks don't succeed. Meanwhile, Araghchi will be visiting China on Monday for the Shanghai Cooperation Organization Summit. NVIDIA CEO Jensen Huang says the U.S. government doesn't need to be concerned about the Chinese military using U.S. technology to improve their capabilities. Huang told CNN that China will avoid the technology because it can't be relied upon and may be limited at any time. Chinese military adoption is one of the key concerns Washington has raised in putting increasing restrictions on tech exports to the rival.
Well, Australia's Prime Minister Anthony Albanese heads to Beijing today, saying he wants deeper cooperation with China and sustained bilateral relations. For more, let's bring in our economy reporter, Swati Pandey in Sydney. And Swati, so far, of course, Albanese kicked off this trip on Saturday to China, so we've heard from him in Shanghai. But what's been the tone of the discussion so far, and then what does he also take to the capital?
Hi. So the tone is actually very friendly. Albanese is in China to boost economic and trade relationships with China. Remember, China is our top trading partner, takes up about a quarter of Australian exports. And the major reason why Albanese is doing this trip is to further boost those ties, deepen the economic relationship. And Albanese did a press conference on the weekend on Sunday where he launched Rubio the Roo, which is our tourism icon. It was part of a launch of Australian tourism. So that is all part of what Albanese is doing in Shanghai. And today he's heading to Beijing, and then he'll go to Chengdu. All these places have Australian consular offices as well.
It seems like, I mean, there has been some critics, right, that have said that, you know, he's visited Chinese Xi Jinping before he met with Donald Trump. I mean, where does it tell you of where this relationship is going? Because I think as we speak, we're hearing about some potential deals. BHP signing some MOUs with the likes of CATL, BYD on battery tech and electrification here right now.
Yes, that's right. I mean, it was not by design, really, that Albanese is meeting with Xi Jinping first. He did want to meet with Donald Trump before he met with China's Xi Jinping. And they did have a meeting scheduled, but in the event of the Iran-Israel war, Trump had to cancel the meeting with Albanese at the G7 in Canada. And as a result, it just so happened that Albanese is now meeting with Xi Jinping first before he's met with Trump. But that was surely not by design. It definitely does also goes to show that Australia's relationship with China from an economic standpoint is really important. But at the same time, US is our #1 strategic ally. And so Australia is in the situation where it is have to walk this really tough, tightrope walk, which is really hard because it's kind of stuck between choosing one side when it doesn't really want to choose.
All right, Swati, thank you. Swati Pandey there joining us out of Sydney on, of course, the Prime Minister's trip to Shanghai and heading to Beijing next. So coming up, we're going to have more on the Australian Prime Minister's trip to China later on in the show. We'll get analysis from the head of Australia-China Relations Institute at the University of Technology, Sydney. That's in the next hour. Plenty more ahead. This is Bloomberg. The European Commission says any escalation of trade disputes should be avoided while calling for a level playing field. The competition chief, Teresa Ribera, spoke to us earlier.
Trade provides prosperity, and I think it is a good thing. And in general terms, the global value chains are so obviously important for anyone that we should avoid any type of trade escalation, trade war among the different countries between the different geographies. But of course, we need to ensure a level playing field. We cannot keep our very open economy in Europe in such a context that there may be many people willing to be part of our single market, but that may not be working with the same rules, the same approach, so to reflect the right prices according to the real cost. So I think it is good to explore with the rest of the world how we can work together, and it is good to try to avoid this escalation with the United States. China is a great country. Of course, we need to be sure that investments flows are fair and that we do not harm each other.
When it comes to fair trade, what sort of message have you given to Beijing when it comes to overcapacity, not only on clean technology sectors, but also, of course, on rare earth exports?
There are two things that you are mentioning in your question. One of them is, yes, we need to ensure that the overcapacity, the production beyond what it may mean, the domestic demand could overflow over markets. That could be pretty harmful for those that also produce in other geographies. So we need to be responsible, and these formal and informal conversations between the different governments is going to be key. Then there is another issue that you are raising in your question. What about the availability of rare earths, raw materials that may be critical for the new economy, both in terms of the renewable energy solutions or in terms of the digital transformation of our economies? And it should not be a bottleneck killing the possibility of prosperity all over the world. So that is another bullet where we will still need to talk, to discuss, to avoid harm.
When it comes to competition itself, given Washington's tariff threat of 30% by August 1st, is that going to hurt Europe's ability to compete in global markets in the United States? What are your expectations of what that could do to trade flows?
I think it is very bad news. I cannot understand how any country can think that getting isolated from the rest of the world is a good thing for its economy. To what extent fixing the way they want to produce, sell and cut the ties with other providers, suppliers all over the world is not good news for anyone. So I think that it is not good for Europe, it is not good for the United States, it's not good for anyone in the world, because the size of the American economy is so important that it would have an impact, of course. But it is also true that it represents more or less 17% of world trade. So we need to pay attention, to prepare, to be sure, to the extent possible, that this does not become a reality. But if it finally pitifully becomes a reality, we need to keep on working to build resilience and to build partnerships with the other partners, the other allies in the world.
That was the European Commission Competition Chief Teresa Ribera speaking to Bloomberg's Sherry Arm. We'll have much more ahead. You're watching The China Show, and this is Bloomberg.
Welcome back to The China Show. Here's a look at the CSI 300 just a half hour into the session. It's a beautiful day out in Shanghai here on this Monday morning. Stocks are doing, relatively speaking, overall well compared to the rest of the region here today. Obviously, the headline news recently has been Trump threatening these 30% tariffs on the EU and Mexico, which has led to stocks to wobble just a little bit. But onshore is looking pretty solid here. We're still waiting the trade data out of China. And, of course, tomorrow, that data dump as well.
Yeah, going to be a really big start to the week just to really get a sense check on how is China's economy faring and how much should it really hold up in the first half when you've got those expectations that we're going to see that deterioration in the second half when we get more clarity around the direction for tariffs. But this is the broader picture today in the session, and you can see here that stocks are trending fairly flat right now. US futures a little bit under pressure, and we're seeing gold really actually kind of bid. I mean, up 0.3%, but certainly it is maybe that kind of haven appeal as well, given that you've got President Trump, as you said, threatening these further tariffs on the EU, also on Mexico, and that question, the taco trade, is it alive and well or not exactly?
Yeah, you got to wonder why markets continue to brush it off, right? Is it the fact that, they're more so not thinking that these are just negotiation tactics and that he is going to back off. But, some are saying, no, you cannot rule that out either. Right now, as you approach closer to these deadlines. And certainly, the data in China, as you say, has held up. So has the U.S. But we're also waiting and be cautious about when that data starts to sour, right? But even when it comes to this week alone, it's not just a data dump, right? That US CPI print might be quite telling for risk assets moving forward, especially the bond market, given the solid performance we saw in the first half based on these Fed price cuts. But now things have recalibrated a little bit. Now that we have had those jobs reports have been pretty solid as well. And so this inflation print is really going to dictate what the direction of the Fed's going to be and where these bond markets go.
Yeah, absolutely. I mean, if you get that hotter print, then it sort of pushes back those expectations around Fed easing. And I think what was interesting is that, yes, you had the pricing around the September meeting. Does that get pushed out? And how much further does it get pushed out as well? But just to mention, we have actually just had the year-to-date figures coming through for the China trade figures. And what we're seeing so far far as that exports have risen just over 7% on the year, and China as well saying that their domestic demand has expanded and also stimulated imports. So that's the preliminary figures that we're getting here. Of course, we're waiting for the monthly figures and also for the yuan terms, the dollar terms as well. But that's just year to date so far. You can see that rise in exports, kind of unsurprising given you had that détente and that truce that was signed allowing exports to restart as well.
Yeah, so I think that 90-day window certainly may be helping these numbers as well. But yes, we have to get the month-to-month ones to really kind of see how things look for June specifically here right now. But you mentioned about the Fed, right? The whole divide that we're seeing among FOMC officials is the impact of inflation from tariffs, right? And if we see the CPI print stronger, that could set a whole lot of discussion of what really goes on. And then there's a whole possibility, why has the dollar turned negative continuously? We've seen it come off slightly, just given some of the risk-off moves that we're seeing. But then again, is it really about rate levels and rate differentials? I don't think so anymore. There's a lot more possibility now of people pricing in the potential for the FOMC to bow to political pressure, and a lot of chatter about Jay Powell's future as well.
Yeah, this is actually a really interesting talking point, and one that's certainly not going to go away anytime soon. But we actually had an interview with Deutsche Bank on this, and it's saying that this is really maybe the wild card, this potential dismissal. What are the sorts of avenues that President Trump could take as well to continue to heap pressure on Jay Powell to consider stepping down? And the latest one, for instance, is the renovation costs and how those are perhaps growing more than expected or more than initially anticipated. But this is what we heard here from Deutsche Bank, saying that essentially this would have major ramifications because you've got the Fed and the dollar as well sitting at the top of the whole monetary system.
They're kind of projecting if, in fact, this happens, right? But they're saying a sell-off in the dollar, sell-off in treasuries, right? 3 to 4% drop in the greenback, 30 to 40 basis points in terms of a fixed income sell-off, and that you would put a sort of a price premium on these two assets very closely moving forward, just given this whole questions of central bank independence and the like.
Yeah, all right. Let's get to one of our top stories as well this morning because, of course, President Trump is saying that the European Union is talking to the US on trade, and that comes after he unleashed his latest tariff ultimatums, threatening a 30% rate for the bloc and also Mexico from August 1st if they can't negotiate better terms.
So the European Union is talking to us. They want to open up their country. I would say Japan to a much lesser extent in terms of opening up their country. South Korea wants to make a deal other than tariffs. Right now, as you know, they're paying a substantial tariff, but they want to make a difference. So some of these deals, maybe I'll change them and maybe I won't.
Let's bring in our Chief North Asia correspondent, Stephen Ingles. And Steve, I think a lot of people are on the same page. Whether you're a negotiator or whether you're a trader, you're still trying to figure out how serious is President Trump about these tariff threats?
But he seems like he is losing a bit of patience now, too, Steve.
He is, and that's why he's kind of said, well, now this is the firm deadline, August 1st. I'm not going to go beyond that, but we've heard that a similar vein as well before. And he said he wanted 90 deals in 90 days. He's got, what, 1 or 2? And a truce with China. So over the next 18 days, Asia time is for that August 1st deadline. Can he get 88 deals in 18 days? We all know that negotiations heat up and come to fruition the closer you get to the deadline. But that's a lot to accomplish in that amount of time. EU, there's been waning and waxing confidence in some sort of deal from the European Union as well as from Donald Trump. Right now, we're hearing, of course, the EU is not putting all its chips in the pot for making a deal. They are stepping up engagement with other countries hit by Trump's tariffs, like Canada, like Japan. But they're also, playing poker in the sense that they're extending the suspension of their trade countermeasures against the U.S. until August 1st. And there's a basket of these things, $24.5 billion worth of U.S. goods that could be hit in the current countermeasures, which are suspended. And we're hearing as well that there's a second batch of countermeasures that are going to be put forth to EU members as soon as today, totaling about $84 billion. Again, there's sticking points on automobiles, there's sticking points on agriculture. The EU wants no higher than 10% tariffs for its ag products to the United States. They're far apart right now because Trump is saying 30% across the board, and that's not including the sectoral tariffs, of course, on pharmaceuticals, on steel, on aluminum, and the the like. So 20% was the April 1st or April 2nd tariff. They brought it down, baseline 10. He threatened 50 because he got frustrated. Now it's down to 30. So we don't know what it's going to be.
What do we know about India and South Korea right now?
Yeah, I'll just mention Mexico. I forgot about Mexico.
Oh, yeah.
They also got 30%, right? There seems to be some progress, but again, it's the same narrative. Progress, one step forward, one step back, or two steps back. He did write a letter to President Sheinbaum saying there's been progress on the fentanyl border issue, but not enough. So again, we'll have to wait and see. That's in the wait and see category. India also wait and see because they're hoping to get some sort of interim deal, and then they can deal with the nitty gritty. Once you have a framework and an interim deal, then you can go down and do the negotiation on the individual issues like U.S. genetically modified crops, non-tariff barriers on agriculture as well, pharmaceuticals, a number of different issues there. Again, I wouldn't be betting all my chips on that one right now. They got 26% rate initially. They're looking to land a rate below 20%. South Korea, Trade Minister just back from Washington, meeting with Jameson Greer, the U.S. Trade Representatives, and also, of course, Howard Lutnick, the Commerce Secretary. There's confidence there. They're saying we are reaching a landing zone swiftly on some sort of deal, possibly. Talks have entered a critical phase. Again, it's in the wait-and-see basket.
Steve, thank you. Stephen Ingles, our chief North Asia correspondent there. And meanwhile, U.S. Secretary of State Marco Rubio says a summit between Presidents Trump and Xi is likely after the top diplomats from the two countries met in Malaysia.
The odds are high. I think both sides want to see it happen. Obviously, we have to build the right atmosphere and the right deliverables so that a visit isn't just a visit, but it actually has some takeaways from it that are concrete. But there's a strong desire on both sides to do it. The president wants to do it. The Chinese side wants to see it happen. President Xi said that publicly. So I think the odds are high. I don't have a date for you, but I think it's coming. It'll happen.
All right, that's what came over the weekend. We're taking you to live pictures now out of Beijing and what we're hearing from this Bureau of Statistics briefing here as we wait this trade data for June, right? So we got the year-to-date numbers, which did see some decent growth here of 7% in yuan terms from June to January to June exports, I should say. And what they're saying right now is China needs to work hard to maintain trade growth in the second half. China trade resisted pressure and showed dynamism in the first half. Those words coming through from the Vice Minister of China Customs there at this briefing. So talking a little bit more about how resilient these numbers have been, and it really has to do with, I'm guessing, front loading, really.
Yeah, that's certainly been sort of the big sticking point or the question, really, because we had the initial truce that was signed by the US and China in Geneva, and so that opened the window for exports, and then we've been benefiting from that, or the Chinese economy has been benefiting from that. But of course, as we said, awaiting these key trade figures as we hear from the Vice Minister of the China Customs saying that trade has resisted the pressure and shown some dynamism. But let's get more with our China correspondent, Min Lo. So talk to us about how important these trade figures are going to be today, and also just the sheer amount of data we're expecting from China between today and tomorrow.
Yeah, I think our team is now crunching the number to figure out what the June number is. But year to date, you're looking at 7.2% increase in exports. And as you said, you see that big dichotomy between the export numbers and the import numbers, right? It's negative 2.7 for imports. It really shows you that despite what the officials were saying about how domestic demand is expanding and bolstering import numbers, it's still pretty weak, really, if you look at that number. And the exports are really bolstered by the trade truce, the front loading of shipments. Economists have been telling us that we really have to prepare for a potential, fall off in demand for exports in the second half of the year. And of course, we are still waiting for the mid-August deadline when the temporary truce will expire. And some economists believe it's still a possibility that maybe the tariff levels could still increase in the later half of this year. So there's still a lot of uncertainty there, and a lot still needs to be done to really boost, especially domestic demand as a potential cushion against the decline in trade numbers.
You just came back from KL in this ASEAN foreign ministers meeting, and it seems like now there might be some sort of talk or negotiations between, or at least a chat between Presidents Xi and Trump. What do we hear?
Yeah. So I was there, and I remember when Wang came out of that meeting, he was very tight-lipped again, didn't want to share any further information. It was from Marco Rubio that we heard that maybe this meeting could lead to, or could lay the groundwork for that Trump-Xi meeting sometime. He refused to put a date on that, and it's still very uncertain, right? Because you heard Rubio there saying that they are working towards, building the right atmosphere, having some, concrete deliverables that they will be able to work towards when they time that meeting tracking. And again, if you talk about concrete deliverables, one of the biggest sticking points now is in regard to trade. And that's where Marco Rubio actually doesn't have a lot of power. We know that Scott Bessent and Howard Lutnick, they will be kicking off this second round of trade discussion sometime in early August, ahead of that deadline in mid-August for the temporary expiry of that truce. So it really depends on how that goes. Whether that will, derail a potential meeting is still a question.
Right, that was our China correspondent there, Min Min Lo, for us. And just taking you back as well to those live pictures we've got this morning, given we are awaiting these trade figures to be released. But what we're hearing so far from the Vice Minister of the China Customs team, Wang, is saying that the trade figures, or what we see in terms of the trade numbers, certainly resisting the pressure, showing some dynamism in the first half. But we are awaiting these figures, and we will possibly see the impact of front-loading in the last 3 months or so. All right, we'll leave that there, but we will say what we're getting to next, which is, of course, a deeper dive into the economic picture. Also, what's becoming a really big sticking point in the Chinese economy right now, the anti-involution trend. Coming up next on the China Show, we've got UBS Global Wealth Management talking about their outlook for Chinese stocks and why they're favouring tech shares in particular here in Hong Kong. We'll have more ahead. This is Bloomberg.
But you could say, it's a kind of a catch-22 is that the market's not panicking, then it may embolden Trump administration to do something. But our view is that, we already know enough about the tariff framework. 10% is the minimum. China is the ceiling. China +1, transshipping is in the middle, right? Then what about EU? Okay, there is a question mark, but we all know that at the end of the day, EU is also a very big economic bloc, very important for the US economy. It cannot get too worse.
Way out there, head of research and chief economist for APAC at SocGen, speaking to us earlier about why we are seeing markets kind of continue to brush off these concerns of tariff threats and the like, which we seem to be getting on a daily basis here. Your China market check is looking like this here right now, looking pretty good against the backdrop of what has been some pretty shaky stocks, in particular what you're seeing in Japan, for example, here. But you are seeing some standouts in the Hang Seng CSI 300, despite these tariff threats from President Trump as well. The cost is pretty flat this morning as well. Let's bring in Eva Lee, head of Greater China Equities at UBS Global Wealth Management, Chief Investment Office. It seems like Chinese markets have been doing quite well this year, despite all these tariff threats.
Yes.
Is it complacency, or do you think something like this is sustainable?
Well, I think first we need to understand what is doing well, all right, which segment. The tech space, right, DeepSeek movement definitely have driven more investor interest onto the space. Apart from it, the yield sector, like utilities, banks, those that give you like, used to be 8 or 9% dividend yield, and now it's like 6-ish. Comparing to the China government yield, less than, I think, 1-ish, or maybe lower. So that actually have drawn investor interest to the space. So, but if we start looking at the underlying economy, yes, the tariff truce have extended the sort of rush of export order, the tackle trade, that people being a little bit more complacent what will happen to tariff. So all these have helped the overall first half 2025 performance.
But moving into the second half then, what's your expectation? It doesn't sound quite as optimistic, or at least a lot more selective.
Well, I think if we look at what people talk about tariff, now we have more of this sort of pre-August 1st, some of the tariff coming through. Looks like market expectation is, except China, 10 to 15, China 35 to 40. So this is sort of expectation. If it is worse than that, or if they play some tricks about transshipment, like what they have done in Vietnam, that would affect China as well. What would they do with Mexico transshipment? All these other places targeting China, that will also be a swing factor. Apart from that, third quarter, fourth quarter, for sure, in terms of GDP growth rate, we have an easier base from last year. So it shouldn't be that bad. It may not be over 5%, but overall, I think definitely better than what expectation is at the beginning of this year.
There's a lot of talk domestically about what's going on, fierce competition, involution and the like.
Yes.
Do you see these price wars being more dangerous than what we're seeing externally in tariffs right now in China?
The weakness in PPI, the CPI, like the deflation impact, even before the tariff has been an issue. Remember last year we had that sort of negative figure. Now for sure it would affect some of the exports. Some of the orders cannot ship to the US, right? So these will stay in China, or maybe they will sell it to Asia. But that deflationary impact, for sure, is one of the key concerns amongst a Chinese leader. That's why they started off with these sort of, they describe it as supply reform onto steel, onto the solar, on specific sector. They know that supply is already ample. But the difference now versus 2016, when they was quite successful in supply reform, this round it's a lot more challenging because the supply sources is a lot more fragmented. So in order to really, of course they already started to slow down the supply, cut that, cut this, but whether that will be eventually reflected into inflation or stopping the deflation, I think it's not as easy as it is.
Yeah, I wonder because you've got that preference for tech, but I also take a look at the performance of tech stocks. And if you look at the gauge, it's sort of relatively flat over the past few months. But some certain selective stocks are really feeling the pinch. And that's like Alibaba, for instance, or JD or Meituan that are really engaged in that big price war. Does that actually end up having a bearing then on your preference for this sector?
For sure. I think this is actually why when we shift stock, we shift from the e-commerce space to the entertainment portal. Like, I don't want to name the stock, but you know what I mean, right? The fact is we have gone to, people worry because remember is it 2020? They have done some sort of competition before and the margins have pressure. I think this will be similar, that they will feel the margin pressure as reflected in second quarter results, no doubt. The stock corrections were quite quick too. So when we sort of looking at the leading portals, they already sort of back to pre-DeepSeek level. So I think now it's where the catalyst will be to revive the momentum. I think AI or the cloud computing had been one of the weak points, remember, at first quarter result. A select companies doesn't give you very nice cloud revenue growth. So if there is any sort of potential positive momentum there, as reported in second quarter result, or if the provider of AI chip now, I think he's going to China, he has a moderation of sort of new chip, that will potentially help to alleviate people's concern about chip supply. That could be potential positive catalyst for the sector.
Okay, so maybe some potential supply side reforms. What can I expect for property? There's a lot of speculation. We're going to see some property stimulus.
Yes. Well, the reasons why people speculate that because the June sales, the July, the first 2 weeks of sales were really weak. And again, yes, I think there is a potential, even if it is not this week, even by the end of July Politburo meeting, there could be some more measure. But again, what we describe it's not the bazooka type measure. It's unlikely to be national government coming through and say, I'm going to buy all the vacant supply. It's not like that. So, i.e., this is still a sector unlikely to perform on a sustained basis.
What's the thing that investors really need to be watching out for in the second half that maybe hasn't been factored in or priced in just yet?
Again, deflation. Second, of course, the tariff actual impact, particularly on the transshipment side. Consumptions, whether the consumption sort of weakened because we have a very nice May numbers. I think these are the key ones.
Where should I lean to, A or H share market for the rest of the year?
At the moment, A actually better than H because of the leading portal not doing well. But if you sort of think about on overall second half, unless there is a major heat up of geopolitical risk, people will go back to Asia. Or else, I think H will still outperform A in second half this year.
Okay. So do you think that premium can still, or the discount can still narrow?
Well,
here?
I mean, select stocks, of course, it's so narrow, it will widen further. But on an overall basis, yes.
All right, Eva, thanks so much for joining us this morning. That was Eva Lee, the head of Greater China Equities at UBS Global Wealth Management, Chief Investment Office. And just getting some lines that are crossing the terminal now this morning, because we have Australian Prime Minister Anthony Albanese, who's on a 6-day trip to mainland China, visiting Shanghai, Beijing and Chengdu. But the lines that we're getting this morning is that Anthony Albanese is saying that the China relationship is very important for Australia, and also that Australia wants to see a stable and secure region.
We've got plenty more ahead. This is Bloomberg. All right, market check here. Movers this morning. We're watching Beijing Mining. Those first half prelim numbers looking pretty good. The stock is up 1.5% here as well. Bloomberg Intelligence saying, look, this earnings does set the stage for an earnings upgrade potentially for the smelter here. And we're watching very closely these silver stocks in Asia. So those are all rising. The metal rises to the highest since 2011. And we are seeing some of these China stocks there surging 7 to 9% here. Hunan Silver, for example, up close to 10%. We got plenty more ahead. This is Bloomberg. $11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break here right now, and we are seeing a bit of pressure when it comes to equities here this morning. We're down about 1/3%. Asia Pacific is flat. You are seeing some decent bids across in Chinese markets, for example. The Kospi is kind of doing, relatively speaking, a little bit better against some of these tariff headlines as well. 147 for dollar yen. A bit of strength there for the Japanese currency here this morning, and yields ticking up higher by 3 basis points on the 10-year.
Taking a look at broader markets this morning, you've got the MSCI Asia Pacific Index sitting fairly flat today. US futures as well under pressure, and you have seen gold being a bit bid. But what's driving that is really President Trump vowing 30% duties on the EU and also on Mexico come August 1. If they can't reach a trade deal in the interim. But certainly it is trade, it is these relationships between major economies that's driving sentiment in the session so far. Plus the eco figures, of course, can't forget. Big week.
Yep, and certainly that's one to watch. The data dump, US CPI, that's all on tap here as well. Also, that what we're expected here out of this trip in China from the Prime Minister of Australia, Anthony Albanese. In just the last couple of minutes, he did speak to some reporters in Shanghai and really highlighting how important that relationship with China is. He called it, quote, very important for Australia, and Australia wants to see stable and secure as a stable and secure region. For more, let's bring in our economy reporter, Swati Pandey. She's been tracking, of course, the Prime Minister's trip to the mainland. So far, just talk us through what's really in store for Albanese.
Yes, so Albanese is on a 6-day trip to China, started off with Shanghai. Today he's heading to Beijing. And then he goes to Chengdu. All of these places have consular offices. And Australia is really wanting to boost that economic and trade relationship with China. There's also a delegation of businesses that's traveling with Albanese. So we have CEOs of Fortescue, BHP Billiton, Rio Tinto, some of Australia's biggest iron ore companies, and banks as well. And Albanese was giving a press conference, like you just mentioned, just a little while ago, and the CEOs were also present, and they were talking about decarbonization of steel and boosting that green iron trade with China. So the conversation so far has really been focused on trade. However, Albanese's press conference, even yesterday and today, has kind of been overshadowed by questions around security and some reporting from the US around which side should Australia take in the event of a Chinese war in Taiwan.
Yeah, just get into the more details on that one. It is a report from the Financial Times, and as we understand it, the US is making a request, or what the Financial Times is reporting is that the US is making a request of Australia to essentially spell out how it would respond, rather, in the event of kinetic conflict with Taiwan. But how realistic is that, and how much is that going to be overshadowing these meetings, important meetings for Albanese over in China?
Yes, that's right. I mean, at least as far as the press conferences are concerned, questions from journalists are almost entirely around this. The timing of it is a bit unfortunate for Anthony Albanese, and he has so far been able to kind of dodge those questions. He has repeatedly said that China is an important partner for Australia. The relationship with China is important for Australia. At the same time, he's also saying that that relationship with US is critical as well. So it's that tightrope walk that Australia has to do. The US is asking it to choose any one side if the reporting in FT is to be believed, and it is incredibly difficult for Australia to choose that side because China is our top trading partner, accounts for about a quarter of Australia's exports, and US is our top strategic ally. So it's a difficult one for Albanese, but so far he's done well in avoiding those questions or kind of responding in a way which doesn't really give anything away.
All right, that was Bloomberg Swati Pani there in Sydney. And let's bring in James Laurenceson. He's director of the Australia-China Relations Institute at the University of Technology, Sydney. And James, Swati was just making the point that so far Anthony Albanese has been able to sort of bat away this reporting that was from the Financial Times that China should really spell out how it planned to respond to any sort of Taiwan conflict. But how much is that going to cloud this visit to China, do you think?
Oh, look, I think Anthony Albanese is very much staying on message, and he's got good reason to. You know, you've really got to wonder about the Americans in this case. I mean, they've waited until Anthony Albanese is on the ground in Shanghai to make this request of Australia. And let's not forget that this is a war that America hasn't even committed to. So I wouldn't be surprised if there's some annoyance in the Prime Minister's travelling touring party as well.
Yeah, it certainly has made it a bit more complicated. But how do you think this overall, this trip is going to evolve, right? Obviously, he's there to shore up economic ties with the mainland. How does he balance the security ties with the economic ones?
Well, the Australia-China relationship has been on a fairly stable path for more than 3 years now. Anthony Albanese has made it clear that economic ties are the priority of this visit. He's also made it clear that he continues to emphasise that China is a major trading partner for Australia. And it's not just about the total, it's whether you're talking minerals, fuels, crops, livestock products, tourism, education. China's Australia's #1 market across the board. And so that will remain the Prime Minister's focus.
What about the relationship between Canberra and also Washington, and I guess the way that that's developed since President Trump took office? I mean, we haven't even seen a meeting yet between President Trump and Prime Minister Anthony Albanese. That sort of unpredictability, does it also change the calculus for how Canberra wants to deal with Beijing?
Well, it certainly doesn't make Canberra's life any easier. But on the meeting, I mean, let's not forget that just last month, Prime Minister Albanese flew halfway around the world to the opposite hemisphere to a G7 meeting in Canada. Australia's not even part of the G7, but he went there hoping to secure a meeting with Trump. But it was Trump who left early and left Anthony Albanese hanging, and plenty of other world leaders too. And in the economic space, I mean, Australia would love to sell more goods and services, iron ore, etc., to Washington or to America, but America's just not interested in buying them. And in fact, they're making it harder for Australian companies to sell to America, putting up a 10% tariff on all our exports. Now, that compares to a 1% tariff that China's put in place owing to the China-Australia Free Trade Agreement.
How will you classify this relationship then, right? You mentioned it's friends, not foes, for example. I mean, it certainly is. It seems like they're putting Albanese in a position that he has to choose between two sides of whether it's the U.S. or China. How do you see this all playing out, James?
Well, Anthony Albanese won't choose a side, and no other country in Asia will choose a side either. I mean, I describe the relationship as quite constructive and clear-eyed. Beijing and Canberra aren't under any illusions that they're geopolitically aligned, but at the same time, they both recognise that there's an awful lot of shared interests in this relationship, and so that's what they're putting the focus on right now.
What about other issues, though, and ones that have, of course, irked a lot of governments worldwide, is this sort of no-limits agreement or the no-limits friendship that Beijing has with Moscow? Is that going to be coming up at all, do you think?
Oh, look, I'm sure it will. There'll be plenty of issues that'll be coming up. You know, human rights, all these sorts of issues. Australia has real concerns about China in a whole lot of domains, particularly in the human rights and security domain. But look, that's not unusual. This has been a challenging relationship for Australia since diplomatic ties were struck more than 50 years ago. But the agreement both sides have come to is that they'll raise and recognise those differences, but they're not going. They're going to handle those differences calmly and professionally, and they're not going to let those differences define the entirety of the relationship.
James, we'll leave it there, but thank you. James Laurenceson there, Director at the University of Technology, Sydney, Australia-China Relations Institute. And subscribers can watch us live and see our past interviews in our interactive TV function, TV Go. You can also dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation. Send us instant messages or questions for our guests throughout the hours. Check it out at TV Go. Well, initial report on the Air India flight that crashed last month says fuel supply to both engines was switched off a few seconds after takeoff. The Boeing Dreamliner crash killed all but one of the 242 people on board. Let's bring in our India aviation reporter, Mihir Mishra, joining us now from New Delhi with the latest. So, Mihir, just tell us a bit more about what this report tells us about what happened in this crash.
Hi, good morning, Yvonne. You know, what we know for now is that, you know, the plane took off well. The pilots were well rested. Everything went as per the schedule. But 3 seconds into the flight, there was a case where both engine shutdown happened. Now, the both engine shutdown happened because the fuel was cut. Now, the report does explain that, you know, the one pilot did ask the other that did you switch off the fuel. The other pilot responded saying that no, he did not switch it off. So there is confusion as to how was the fuel switch switched off. Now, the other thing that the report says that the fuel switch was restarted or switched on. The first switch was switched on 10 seconds after the flight, and the second was switched off 14 seconds after it was switched off. Now, these are two, then it goes on to say that, you know, the RAT was deployed and the plane, it was very difficult for the plane to take off from there, and, you know, it ultimately crashed. There are so many unanswered questions in the report. For instance, why did it take 10 seconds and 14 seconds to switch on those fuel switches? Now, that is something which is not explained in the report yet. It doesn't share the cockpit conversation during that crucial period between the two pilots as to what happened between the two pilots, what did they discuss during that particular 10 seconds when the fuel switch was off and the plane was not able to lift off because there was no power, the engines were switched off. The other thing that it does, so these are the crucial bits in the report for now, but it does create a lot of ambiguity in the sense that it has not answered a lot of questions in terms of what happened in the cockpit during that crucial period, which is crucial to this investigation.
Yeah, exactly on that point, Mihir. Where does the investigation go from here, and when would we expect the final report as well?
Yeah, so the investigation, under the ICAO norms, the preliminary report should come within a month's time, and a final report should come within 12 months. Any delay beyond 12 months will need the country which is investigating the case to go to ICAO and take an approval for an extension in that 12-month period. So one thing is certain, that the final report should be out in 12 months. But what does the report look at now? What does the investigation look at now, post the preliminary report? Now, the investigation is progressing. The team has transferred all the evidence that they have received from the Ahmedabad flight crash to New Delhi. They are working on those evidence. What they are also trying to do, the key focus of the investigation from here would be on those switches. Did those switch go off because one pilot or the other switched it off, or did it go off because of some technical problem? Of a detailed analysis of the data from the aircraft, and also the analysis of the cockpit voice, of the conversation that the pilots had during that crucial period, will give out some sort of a sense as to what exactly happened on that day with the aircraft that led to its crash.
That was Bloomberg's India aviation reporter Mihir Mishra there in New Delhi, and we'll have plenty more ahead. This is Bloomberg. Just some breaking news here this morning around Jane Street, and what we're understanding is that they have deposited 48.4 billion rupees. This could be into an escrow account in order to comply with an order from the Indian Securities Market Regulator, which the question really is this going to allow them to resume trading? Jane Street is saying that they've got no immediate plans to resume options trading just yet. We know that, of course, Jane Street has very much been in the crosshairs of Indian regulators or market regulators over in India, and there is this concern that they had illegal index manipulation and made unlawful gains. Again, that's according to allegations from SEBI, or the India's Securities and Exchange Board. But the latest on this is that Jane Street has deposited 48.4 billion rupees to comply with this investigation. So certainly a very much a developing story, one that could have major ramifications for Indian market operations as well. But let's shift now, take a look at the European Commission, because they're saying that any escalation of trade disputes should be avoided while calling for a level playing field. The competition chief, Teresa Ribera, spoke to us earlier.
Trade provides prosperity, and I think it is a good thing. And in general terms, the global value chains are so obviously important for anyone that we should avoid any type of trade escalation, trade war among the different countries, between the different geographies. But of course, we need to ensure a level playing field. We cannot keep our very open economy in Europe in such a context that there may be many people willing to be part of our single market, but that may not be working with the same rules, the same approach, so to reflect the right prices according to the real cost. So I think it is good to explore with the rest of the world how we can work together, and it is good to try to avoid this escalation with the United States. China is a great country. Of course, we need to be sure that investments flows are fair and that we do not harm each other.
When it comes to fair trade, what sort of message have you given to Beijing when it comes to overcapacity, not only on clean technology sectors, but also, of course, on rare earth exports?
There are two things that you are mentioning in your question. One of them is, yes, we need to ensure that the overcapacity, the production beyond what it may mean, the domestic demand could overflow over markets. That could be pretty harmful for those that also produce in other geographies. So we need to be responsible, and these formal and informal conversations between the different governments is going to be key. Then there is another issue that you are raising in your question. What about the availability of rare earths, raw materials that may be critical for the new economy, both in terms of the renewable energy solutions or in terms of the digital transformation of our economies? And it should not be a bottleneck, killing the possibility of prosperity all over the world. So that is another bullet where we will still need to talk, to discuss, to avoid harm.
When it comes to competition itself, given Washington's tariff threat of 30% by August 1st, is that going to hurt Europe's ability to compete in global markets in the United States? What are your expectations of what that could do to trade flows?
I think it is very bad news. I cannot understand how any country can think that getting isolated from the rest of the world is a good thing for its economy. To what extent fixing the way they want to produce, sell and cut the ties with other providers, suppliers all over the world is not good news for anyone. So I think that it is not good for Europe, it is not good for the United States, it's not good for anyone in the world, because the size of the American economy is so important that it would have an impact, of course. But it is also true that it represents more or less 17% of world trade. So we need to pay attention, to prepare, to be sure, to the extent possible, that this does not become a reality. But if it finally pitifully becomes a reality, we need to keep on working to build resilience and to build partnerships with the other partners, the other allies in the world.
And that was the European Commission Competition Chief Teresa Ribera there speaking to Sherry earlier on. Switching gears here, and there's been a very interesting sort of, I guess you could say, almost like a soap drama that's unfolding there in a lawsuit here in Hong Kong. In a courtroom talking really about a $2 billion wealth dispute at Hangzhou Wahaha Group. That's one of China's largest beverage empires. 3 people have come forward who claim to be the half-siblings of Kelly Zhong there, who have been considered the only child of the late billionaire Zhong Qingho. For more, let's bring in Venus Feng. She has been tracking all the developments in this court and what's happened so far. And tell us why this case is so special.
Hi, yeah, I was at the courtroom last Friday to see all those Asian versions of successions unfolding in the courtrooms here. And yeah, so the 3 plaintiffs with the same surname Zhong of the entire founding families of the Wahaha Group said that claimed that the late father had some written instructions 1 month before he died about setting up to one of the subordinates, and the note was about setting up 3 trusts, each worth $700 million in Hong Kong for them. But the trust hasn't really finalized all the paperwork, and the father has already passed away, and so that's like the dispute come from. So that's why they now that the assets has been all this disputes in Hong Kong, and they are asking 3 requirements. One is to know more details of one account in Hong Kong's HSBC, and then that accounts they said that are the funds the trust money should come from. And then the second requirement is that they hope they found that there were $1.1 million has been transferred out of that account. So they hope some explanations of their sister Kelly Zhong, and who has taken over the Wahaha Empire since their father passed away last year. And third would be like they hope that the Hong Kong judge would stop her from diminishing or doing more disposal from that account.
So you're talking about 3 trusts, and each trust is $700 million. So combined, you're looking at more than $2 billion. I mean, how much does that actually dent the overall family worth or family fortune?
Exactly. That's a lot of money at stake. And according to our Bloomberg Billionaires Index, the Zhong family has a net worth, or the family fortune would be at least $3.3 billion. So this like $2 billion trust disputes will be like a big chunk of the family assets. And also with such a big money floating around and at disputes, it could also have some influence of the future company management, or how the company's the image and whether it will be impacting the sales and their image, the reputation in the country will be at stake.
All right, great reporting there. Really fascinating stuff. That's Asia's investing reporter there, Venus Feng. And taking a look now at the China Customs officials holding a briefing. We've been hearing from the Vice Minister of the China Customs team there, but essentially about the outlook for US-China trade. He's saying that is picking up after the talks in London. We could have seen that referenced in these latest figures as well, the export figures essentially. But Wang calling for cooperation and dialogue on this relationship as well.
Right. We heard from Rubio after KL that there might be some sort of summit between the presidents Xi and Trump. Certainly had no details just yet, but certainly they're hoping for maybe more talks in the future. Coming up next, we have Insight with Hazan Ahmed.